Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Monday, March 20th, 2023. It's now the 18th. We start off in the S&P 500 daily chart in DeMark looking back to December 2021. I'll zoom into the current area now. The S&P 500 daily chart has printed the combo and sequential sell setup 2 count. And to negate that for end of day on the 20th, there must be a close below 3919.29 for the price flip to the buy setup count 1. And with the close on Friday 3916.64, we'll have to give this the benefit of the doubt till end of day Monday. S&P price closed back under the Ichimoku conversion line, and a close above the 50% and 100% propulsion momentum up level. That level will become qualified, but it has to get back above the conversion line first, and the baseline will be resistance along with the channel 3 high and the relative retracement up 1, so that's a resistance area still. And the ongoing supply line for Monday will be at 4015.97, and a close above that level for end of day Monday will qualify that supply line. To the downside, the trend factor disqualified down 3 should be halfway decent support. It has been in the past here, and closes below these lines. This first one for Monday is going to be at 3811.98, and this one underneath it is at 3803.66, and closes below those levels will qualify them too. The S&P 500 weekly chart looking back to the COVID crash March 22nd, 2020. I'll zoom into the current area now. And the S&P 500 weekly chart dodged a bomb by not closing underneath the 50% and 100% propulsion momentum down at that level, which would have made it likely close under this close, which is what it needed to do to qualify and confirm this level. And it gets the second chance to start the process over again. So a close below the momentum down levels here for propulsion will qualify that level, and it needs to close under their end of day Friday for this coming week. And there's a fledgling megaphone pattern here. It's printed the 3 for megaphone 3. So a tick lower eventually, lower than this low on the 18th, will print the megaphone 4. The weekly chart printed the combo and sequential buy setup 4 count. And to negate that for end of week, this coming week, there must be a close above 3970.04 for the price flip to the sell setup count 1. And I say if the Fed pauses interest rate hikes rather than hiking by 25 basis points, this ongoing supply line, which starting for next week will be at 4157.57. We really just use it as support and resistance, so we can just consider it resistance. The S&P 500 weekly chart looking back to 2015 or so, I added 2 more lines right here. We'll zoom in a bit and take a look at those. And the 2 new lines are added right at the very low here of this candle on the COVID crash, March 23rd. and I call them Gann angles in the big board chart. So you can notice that when we get there and see the levels that they're at. But the solid one goes through the bottom of this red candle here and the bottom of this candle here. And the one in dashed has one hit at the very bottom of the red candle, and it's inviting price to hit it and validate it, and I'll turn it solid wherever that happens. The NYA top caller chart shows the NYA to SPX ratio, basically value versus growth, having growth screaming underneath this horizontal support and resistance line going back to 2021. I knew growth might have its day in the sun for a while when we had this double top here after value had its day in the sun, but I never expected this. Maybe after it had trouble getting back above the top of this horizontal line that was part of the ascending triangle that value broke out of. I knew value was having a rough time, but this is absolutely incredible. So I see value in the dungeon and not seeing the light of day for quite a while. And growth broke under this uptrend line going back to end of December 21. And now it's headed for this horizontal line support from about January 2022. You can see growth had its moments back in the 22 era here in January, February. This line going down indicates growth having its day in the sun, but then they changed their mind and went to value. We had a double top, and then growth took over again, and then that was it. Everybody was jumping into the value bandwagon until here. And now this, so everybody's piling back into the big fat cap megatechs as it's actually a safe haven play somewhat. And we can consider this a huge whipsaw in the New York AD line. And it broke back under this line here. I kind of drew a diamond pattern, but that doesn't really come into play. I just drew it because I could. But it does have an uptrend line here that it's going after. We'll have to see if it breaks under there. And growth is bumping the New York ratio adjusted McClellan breadth oscillator here up. So it could just keep struggling its way up as growth is going to be the only play that's doing any decent. And the NYA price action brought it back under this support and resistance line at 14,824, and it's down in there, and the next one is down here around 14,300, and then 1,400, and then a retest of that October low here is possible. We'll have to see. Technology has carried the markets before, and it could do it again, so it's something to bear watching. And the ratio adjusted McClellan volume oscillator shows it moving back up and getting away from trying to retest this extreme valley here. So it's back above the line that indicates pretty low valleys, but not the extreme ones. So that could struggle to move up, but nonetheless move up as tech carries the days. And the ratio adjusted New York summation index of the ratio adjusted McClellan breadth oscillator did hit 250, it looks like. Yes, 255.05, almost 250 here. break through that, then it's negative 500, so that's negative 250, and then negative 500. Same thing with the ratio-adjusted summation index of the ratio-adjusted McClellan volume oscillator. It's down to negative 521. And the RSI 14 has made it under 30, so that's some extreme lows there. You can see it doesn't happen that often, and it doesn't stay down there that long. It did here, but it came down here and then bounced out. So let's see if it too struggles to get up as technology carries the days. And the on-balance volume shows traders and investors and just about everybody else running for the exit. So it's testing this uptrend line going back to the October low. So that's not very good to see. I don't know if technology carrying the days can help this, but it might slow it down and stop it from going under this uptrend line. We'll keep an eye on that. And the New York stocks only AD line and its ratio-adjusted McClellan breadth oscillator shows a divergence, and we always give the AD line top billing here. So here we have a downward trajectory in the AD line and an upward trajectory in ratio-adjusted breadth. So again, I don't know if technology alone carrying the days moving forward can halt this divergence, but we'll have to monitor that too. That could bump up out of there and join the ratio-adjusted McClellan breadth oscillator for the stocks only AD line going up. And the intermediate term volume oscillator for the NYA is really screaming to the downside too. It's just about to rival this low if things keep going the way they do. And the intermediate term breadth oscillator is screaming to the downside too. It has a ways to go before it tests that October low. And the instruments above their 200 period simple moving average in the NYA is also screaming to the downside. Look at that. Yeah, it's incredible. It went up past 70. I thought for sure it would just stay in the 60 to 70 zone, but then as Professor Fate would have it, then we went screaming to the downside. The NYA weekly rising wedge chart going back about 23, 24 years or so. And we don't need to zoom in to see that NYA price has fallen out of this range and then back into the falling wedge here. So it has support here in the solid red line, and that's actually a rising wedge starting here before the great financial crisis, and that won't come together for another 10 or 12 years or so. And I draw the line taking into account the bridges that were gone too far to attack. So here's a couple bridges too far here, a bridge too far here, and about 10 bridges too far for the COVID crash. So you can see how I drew that line. And underneath there is the New York AD line and the stocks only AD line, looking back to about the great financial crisis. This one starts in 2007, this one at the GFC. And you can see the AD line has broken out of its rising wedge here for the New York AD line. And the stocks only has a ways to go here to get underneath this blue line, which I should extend. I'll do that for next time. And within this rising broadening wedge pattern is a descending broadening wedge pattern. So I'll zoom in and we'll take a look at these two now. So the NAAD line had the slightest of whipsaws to the upside here and came back under. It's below its signal line here and has a long ways to go to get to the bottom of the descending broadening wedge. Again, we'll have to see if technology can carry the days, and maybe this can stay either up in this area or actually go back above it. Time will tell. And the New York stocks only a D line, same thing, the slightest of whipsaws to the upside here and down below its signal line. So I use the 10 simple moving average for this one and the one above it, the New York AD line. This is the stocks only. They both use the 10 simple moving average. Again, it has a long ways to go to get down here. I think I'll extend this line now. Okay, I extended it, and if it can stay up there for a couple of months probably, then it could have this uptrend line here that's part of the ascending broadening wedge, the bottom line, so then it doesn't need to go back down and test the descending broadening wedge. So let's see what happens there. It has an intersection right here, and that intersection is at the week of the 22nd, and then maybe the week after that too, the 30th, for sure the week of the 22nd. Let's take a look at the European ETF IEV. That shows a head and shoulders topping pattern and then going right into a inverse head and shoulders bottoming pattern. So you can see the neckline in dashed blue for the topping pattern, and the inverse bottoming pattern is shared. So the measure rule from the top of the topping head and shoulders to the breakout area and then move down, you can see it wasn't hit exactly, came pretty close. So then it shot back up, went above the neckline and poked its nose and had a whipsaw above the horizontal line where it would have needed to have a sustained move above it to negate the head and shoulders topping pattern. So I'm still calling the head and shoulders topping pattern valid. Now on to the inverse head and shoulders bottoming pattern here. You can see the shared neckline and then the measure rule from the lowest low of the head to the breakout point here, 26.3%. I couldn't even move it up to here. It would have been off of the charts. And it has this horizontal red line here at its right shoulder, indicating a sustained move under there, meaning at least a few days in a row under there would negate the inverse head and shoulders bottoming pattern. And needless to say, it's absolute insanity over there in the Eurozone. The NASDAQ composite overbought oversold indicator shows the 30 EMA in green doing some mumbling right around here. It nailed the top of the oversold zone here where there's a green line from previous hits, and it did a bit of mumbling, we call it here. And if you look at some of the other mumbling areas, you can see that after mumbling there's a move up or move down. So maybe we'll have a move up with this mumbling action here. The 10 simple moving average hit the bottom of the oversold zone, so it's pretty well oversold. The 1Q and QQQ relative performance ratio. The 1Q is an ETF of the NASDAQ composite itself, and they allegedly strip out most or all of the zombie companies that they think should be removed. And it shows the Andrews pitchfork here, placed very nicely. This uptrend anchored back here at a couple of spots, went through this one. So that's a really good draw there. But it went under the bottom rung that stock charts has. Some pitchforks have 4 rungs, so I might have to add an ad hoc rung eventually, but let's monitor this and see what happens. Technology is definitely trouncing value, as everything in the Qs is in the 1Q. So by canceling that out, we just have what's left in the 1Q other than the instruments in the Qs. So this is an interesting ratio here. The HYG to IEF ratio, that's basically junk bonds versus 7 to 10 year treasury bonds. And I mentioned several weeks ago, you might have to search for this HYG to IEF video, that junk bonds were precariously and almost frighteningly headed up to the very right upper corner here. And I said that's due for a break, and it certainly did. It went screaming below this uptrend line that's been going on since about July of 22, and went screaming below its 50 simple moving average in blue, and then crashing underneath the 200 period simple moving average here in red. The ROC 1, ATR2, and PPO extreme chart shows the ROC 1 below its negative volatility line, which is at negative 1.0. It closed at negative 1.10. Wanted to show the volatility that we're still experiencing. This has been going on for a long time. You can see the ATR2 simmered down a little bit and came back under its negative volatility line here in red. So we need some of those huge candles to simmer down. And the PPO extremes at negative 1.93 here. And I extended this downtrend line in blue so that when this comes into play, it will be somewhat like resistance. It really wasn't that much over here, but nonetheless, another line that the PPO extreme would have to get up above. And if PPO extreme stays below 0 for any more length of time, that's going to be the first one it has to get back above. And looking at the instruments above their 20 simple moving average in the S&P 500, you can see it came down below the red zone, jumped back up into it, and is somewhat stalling there. The S&P 500 index had an adjustment at end of day Friday. They took out 11 technology stocks, or at least what was considered technology. One of them was Visa, so, that's a financial stock actually. So they got moved to financials, and there were other adjustments. So we need to monitor that to see how that affects the S&P 500 moving forward. But anyway, this is still in the red zone and needs to start moving up. I don't know if technology carries the days moving forward. This could laboriously move up, but everything has to wait to be seen. I'm just guessing on this. I think everybody is. And the S&P 500 AD line looks like it's testing this mostly resistance trend line, but it's support and resistance. You can see mainly resistance works best here. So let's see what happens when it tests that, get through that line, and there's an uptrend line here, a rising valleys trend line, had a huge whipsaw here, so those are two lines to reckon with there. And the MACD line looked like it wanted to hook around and start heading up towards its signal line, and all that's happening below zero, negative 32 or so. And RSI 14 is viewed in the thumbnail over here, went above its 21 EMA signal line in red and went back under it, and it didn't get back above the equilibrium line 50 here. So that's really struggling in that area, needs to get back above that and continue struggling upwards. And just like the NYA on balance volume, this really reflects almost everybody and their brother heading for the exits in a panic. The S&P 500 support and resistance levels big board chart shows the gray areas at the downtrend line here, and the daily fortress fed resistance. And price ended the aftermarket hours on Friday at 39.16. So to the downside is these daily horizontal supports here. The bottom of the cloud and the top of the cloud, 26 bars back, concerning the lagging line very close together, S2 and S1. And to the upside is the weekly Bollinger Band mid-band at 39 simple moving average. Daily conversion line, the 200 simple moving average, and the pivot point. And the PE ratios went down slightly, still at historical high levels. You can see them here. Last week it was 18.12 for the forward PE, and it's at 17.93. Trailing 12-month last week 17.85 times, and now 17.62. And the New York traditional McClellan breath oscillator to get back to zero would take just about every single instrument in the NYSE. 3,749 advancers over decliners to get back to zero. Have a great day.